Hello again, everyone. It is 8 o'clock a.m. Chicago time on Tuesday, August 8th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to several months, potentially stretching into year-end. Let's begin with a brief recap from our previous July 11th Your Daily 5. We said that the S&P 500 4383 area was the likely starting point of the next tactical trend. In our Asbury 6 tactical model was on a May 18th positive bias, indicating the likelihood of that trend being higher. SPX subsequently rose by another 4% into July the 27th. We also said that our SEAF model, SEAF is an acronym for Sector ETF Asset Flows. It's our sector rotation model. It's our in-house model. We said it was overweight technology, which is XLK, communication services, XLC, and financials, XLF. Since then, XLK has risen by 5% into July the 19th. XLC also rose by 5% into July the 27th. And XLF rose by 4% into July the 24th. Finally, thank you and welcome to our new subscribers that came to us via our July 10% off subscription sale, which we had mentioned here in our previous Your Daily 5. Now let's look forward and follow money. Number 1, the S&P 500, testing formidable resistance at 43.27. Here we have the S&P 500 daily chart going back to 2022. The orange line is the 200-day moving average. It's a major trend proxy, and the blue line is the 50-day moving average, which is a minor trend proxy. Tactically, the benchmark index is testing formidable overhead resistance at 43.27, which is the March 2022 benchmark high. Circling it here, here's that high, and here's that test that we had on July the 27th at 46.37. 43.27 is unlikely to be broken without at least a corrective decline first. Primary tactical support is at 44.07. That's the current location of the 50-day moving average here in blue. I'm circling it. A decline below it would confirm a minor bearish trend change and would clear the way for a potential test of 43.25 and potentially even 4200. 43.25 is the August 16th high from last year. It's an important support level now. And 4200 is the approximate crossing point of the benchmark high from February 2nd of this year and the intersection of the uptrend line from the October lows of last year, right here at 41.95. Finally, 4100 is the 200-day moving average. That's the major trend. So if we do have a correction here like we're looking for, as long as that correction does not go deeper than 4100, we are still in a major uptrend, and we'll be looking at that decline as a potential new and better buying opportunity. So number 2 is market internals. The Asbury 6 turned negative on August the 4th. The last time I was with you, about a month ago, we said the Asbury 6 was positive as of May the 18th. You see that May 18th arrow here. Here you can see it went back to negative as of Friday of last week, which was August 4th, after capturing 6.7% between here and here in the S&P 500. The dates in each of these cells, by the way, this is updated on our research center every day, usually about 2 to 3 hours after the close, based on the closing values. And there are 6 constituents here. I built this metric about 6 years ago because you can't look at the S&P 500 anymore with volume or something simple like that and get a good indication, an accurate indication of what the internal health of the market is. I think a lot of that has to do with computerized trading, algorithmic trading, which some estimate to be 80% of the total volume that is traded every day. So what we're getting is a lot of days where the S&P is up 80, and then it's up 70 the next day, and then you walk in the third day and the fourth day and it's down 50 and it's down 70. And it forces us to make mistakes, forces us to do things that we wish we didn't do about a week later. So what I did is I back tested my favorite tactical tools throughout my career that I had the most confidence in, and we found 6 that worked really well together. Only one of them had to do with the specifically had to do with the S&P 500. That's the rate of change in the S&P 500 here up top. The other 5 are what I'd call secondary indicators: relative performance between stocks and bonds, asset flows, corporate bond spreads, trading volume, and market breadth. It gives me a much better under the hood look of what the health of the market is on a day-to-day basis. Kind of like when you walk into the doctor's office for your annual physical. He sees you coming through the door. He hasn't seen you in a year. He may make a mental note of what your health may be. Then he sits you on the bench and he's checking your pulse and your blood pressure and your reflexes and your heart and lungs. Now he's got a much more accurate kind of under the hood look. That's what this does for the stock market. So it's negative. What does that mean? It means as long as it stays negative, meaning there are we don't switch back to 4 or more positive metrics here that are on the green side or the positive side, that the market remains vulnerable to beginning a correction, which is quite overdue, by the way. Number 3, sector rotation. We mentioned our SEAF model, sector ETF asset flows. The SEAF model follows the money in market sectors. I built the SEAF model. The first version of this was probably close to 10 years ago because sector rotation sped up. It used to be you could get into a sector rotation trade and it would last for a quarter or two. That is certainly the exception now and not the rule. The whole sector space has really sped up. So what I did was try to make my signals faster and more accurate. I did that by building a model that follows the money as it moves around the 11 sector spider ETFs, which together are the S&P 500. Let's see where we are now. This week, the 3 sectors with the best rankings according to SEAF are in order: communication services, energy, and industrials. How do we come up with the rankings? I built a methodology that measures the velocity of money moving around the 11 sector spiders. And we look at it in 3 different time frames: trading, which is a week; tactical, which is a month; and strategic, which is a quarter. And the fastest money in gets a ranking of 1, and the fastest money out gets a ranking of 11. And then we go through each of these time frames. We highlight the 2 best, the 2 fastest in, which through the end of last week, this model is updated once a week, by the way, on the weekends. But through the end of last week, through 8/3, the fastest money going in on a weekly basis was number 1, energy, and number 2, staples. The fastest money that was coming out was number 10, healthcare, number 11, utilities. So we do this for all 3 time frames, then we add up the scores. The favored sectors are in between 3 and 15. You see them in green. The neutral are 16 to 24. You can see them in yellow. And the avoids are from 25 to 33. So the best score through last week was XLC. It's communication services. It had a score of 3 on trading, a 3 on tactical, and a 2 on strategic for a best ranking of 8. So that's the flip side of that. Is the fastest money coming out is utilities and healthcare. So what do? We avoid where the money is coming out and we gravitate towards where the money is going. The SEAF model has outperformed the S&P 500 in 9 of the past 12 quarters, which is why we think so much of it. With less risk according to beta and according to maximum drawdown. So you can visit AsburyResearch.com if you like and click models to get more information and charts and data that is about the SEAF model. Number 4, investor sentiment. two bullish extremes warn of an emerging market top. So what we have here is the S&P 500 daily going back to the very end of 2017 here up top. And down on the bottom, we have a daily survey of retail futures trader bullishness on the S&P 500. This is a variation of Jake Bernstein's daily sentiment index. Jake Bernstein has been around for a long time. He was one of the first analysts that I was reading and learning from when I was a kid on the trading floor of the Chicago Mercantile Exchange back in the mid-'80s, early to mid-'80s. So this is a variation of his daily metric. It measures futures trader sentiment in the S&P 500. These futures traders are typically near intermediate term oriented trend followers. And this is an environmental indicator. So this means this isn't a timing tool, but this tells us when the market is at a condition or in an environment where you might get a change in trend. That's where we are right now. These futures traders are starting to retract from a historic most bullish extreme of 82%. You can see going back through the chart, the last many times that we've been up at this 82% level were right at or just a little before we've had some major tops of the market. January 2022 was one, Sept of 2021, Feb 2020, September of 2018, and so on. So this is telling us that the market is vulnerable to some kind of a correction here, which is one of many reasons that we believe that the S&P 500 4637 area, that was the resistance level that I showed you that's above the market in the first slide, is unlikely to be broken without an overdue corrective decline first. Finally, number 5, seasonality. History warns of acute August-September weakness. So here we've got seasonality on an annual basis via these 12 bars here that represent the 12 months of the year. The data goes back to 1957. It shows that August and September are the 9th and the 12th strongest, or probably more accurately stated, the 4th and 1st weakest months of the year during this period from 1957. And it also shows that following September, the September low, which by the way happens typically at the end of September, not the beginning. So we still have the entire month of September, to deal with in terms of seasonality. But it also shows that the last 3 months of the year, the fourth quarter, include the 5th, 1st, and 3rd strongest months of the year. So remember, if we're going into a correction here, as the Asbury 6 suggests we are, this sell-off that appears to be emerging here, this overdue correction, could very well provide us with a very good buying opportunity as we get towards the latter part of the year. Remember, as long as S&P 500 4100 is not broken to the downside, the index's October 2022 major uptrend still remains intact. So there it is. These are my 5 most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. You can get a copy of the PDF from this presentation by contacting us via the Contact tab at asburyresearch.com. If you like my approach to investing, you can get more research and podcasts like this one by visiting Asbury Research's YouTube channel and subscribing. Thanks for watching. I'll be back in about a month with another Your Daily 5 via StockCharts.com.